prophetic because he made those comments on the 5th of September. He said oil prices are being held up artificially. Guess what? Since then, oil prices are down about $4. That is, of course, Hardeep Singh Puri. We have Peter McGuire, CEO of Exim Australia. We also have Soumit Pokharna, Vice President Research at Kotak Securities. So we'll get you sort of a global view on this and a local sense in terms of who benefits and who gets hurt. Gentlemen, good morning. Peter, if we can start with you. That was, of course, the India oil minister. Well, prices are down, and down how? So what's going on? Is this, should we, in terms of how markets are looking at this, is this an indication of weakening underlying demand? What's your sense, Peter?
Well, good morning, Prashad. I think a couple of things. Yes, it's very hard to argue against the oil minister because, quite simply, the way he describes it and the rhetoric he uses is so matter of fact. This market is in free fall in a lot of ways. It's taken everyone, I think, by surprise. If you're looking at what happened a year ago and where we are today, you've got a market down $30. There seems to be global weakness if you're looking at the likes of China. And the situation, I think, is plenty of supply. If OPEC were to move forward and increase their supply come end of year, and I know they've pushed it out, but if they were to do something like that, you would see, I would think, probably weaker prices than what we have at the moment. So it seems to be a race to the bottom, and it's a time to be short from a trading mentality and it's incredibly volatile with the whipsawing that we see on nearly within a weekly basis.
So, Peter, how much lower do we go? Say on Brent, do we hit $60 per barrel? What about base metals? Do you have any targets in mind, any levels that one should keep an eye out on?
If you look at iron ore, we're at $90, and it's lower today than what it was over the last 5 years, Rima. So there's the first part of it. You're looking at copper still sitting at that 89 to 9,000 a metric ton. As far as oil, look, if you're sitting at 69, 62, if you asked me a year ago, you said, Pete, it's going to be down $30, I would have said, Rima, you're dreaming. But I tell you what, you can't say that because the market is the market, and the war premium stripped out, geopolitical, even though you've got these ongoing sagas, there doesn't seem to be anything to push markets higher. So maybe you're looking at 65. I'll go out there and say Brent's got the capacity to hit 65, but we've got to have a closer look at it once it is there and what the general themes are across the whole fabric of the oil market.
Peter, since you briefly mentioned about the ferrous space, where do you see Chinese steel prices headed? They've seen a sharp decline, weak data, weak consumption. They're exporting more. So what's the level you're looking at on Chinese HRC prices? And even iron ore, the lowest we've seen in multiple years, at around $90 per ton. Where is that one headed?
Well, Nigel, I think, and it's good to see you, I think you've got to say 85's got to be the next target, but when you're looking at it over a chart, it's just hard to argue against because the downside or the downdraft has been so dramatic. There's the first part, and it's certainly not doing anything, wonderful for the Australian miners. So let's park that there. As far as Chinese demand and what you're going as far as those, those finished goods, I think it's going to be softer prices. So that's where we sit as far as the base metals and ferrous. And I think one's got to be short to probably look at it from a trading perspective.
So, Peter, just one final question then, and then we'll get chatting with Soumit also about the Indian markets and the implications. Apart from China, what else is driving the weaker demand? Are there any other geographies where we're seeing slowing demand?
Well, Rima, you'd have to say across the fabric of Asia, a lot of that is a little bit softer, and certainly if you're looking into the United States. But the overall, I think, picture is that you've had there was supply issues that OPEC took into consideration post-COVID, and now that's coming through to the other side of it where you've got plenty of production, you've got Libya back online, you've got a number of those other OPEC producers all wanting a piece of the apple. And you can't argue from the numbers. When you're thinking about the whole scheme of things, you're at 102 million plus barrels a day of consumption. So it's certainly not weak, but the story at the moment is softer prices and the potential to go lower yet.
Got that. Peter, we're going to come back to you. Let's welcome in Soumit Pokharna as well. He's with Kotak Securities. Soumit, good morning. Good to have you here. So you heard the sort of global piece from Peter. So, what are implications? Who are the big sort of outright beneficiaries, and who gets hurt from a trading perspective for those who are watching?
Yeah. So every coin has two sides. Definitely, falling crude oil prices is positive from India's point of view, and mainly because India's dependency on imported crude is very high. So to that extent, it is positive from current account deficit, fiscal deficit. It is also positive from companies like which are into retail fuel, like OMCs, oil marketing companies, HPCL, BPCL, IOC. And then obviously paint companies and lubricant companies are also going to get benefited, but with a lag. So to that is on the positive side. But if I look on the other side of the coin, when the crude is falling drastically, that means some slowdown is visible in the global economy. And particularly China, the demand is not there. And we all know that China is the world's largest oil importer. So on the flip side, if any macro slowdown happens globally, and if that happens, then India will not remain immune to that extent. However, there is a demand-supply mismatch. The market is also anticipating that OPEC had guided for a production increase. So the supply, if it's because of the supply side, then I don't have any worry. But if it's because from the demand side, then I am really worried from maybe 6 months down the line what happens to the global economy.
Sumit, you started with this being a macro positive. What is the average sort of import price now? Because we are almost about 50% of what we import as a country comes from Russian oil, which I think is, in any case, a price much lower than where, Brent is at, or the Indian basket of crude, etc. is. So I just wanted to, do you have that number? There used to be that, yeah, go on.
Right, that number is not handy right now. Yeah, but definitely we are getting benefited. But need to be noted here that once the crude will fall down, the discounts which we were getting earlier might also fall down.
Yeah. Or maybe the discounts remain the same, so you're essentially benefiting, right? Because the price for Russian oil is also lower then, as compared to where... Yeah.
Right. So $60 comes anyway, it is big positive, irrespective of discounts. If the crude falls to 60, anyway, we are getting big time benefit from the fall in the general and markets. If you look at the other side of it, obviously oil explorers like ONGC and Oil India, they are going to get impacted majorly. And we have continuously been highlighting that because we are seeing the demand pressure globally. So we have seen that ONGC is, and we have been negative on both the stocks, ONGC and Oil India. So far, oil marketing companies are concerned. There I would like to highlight that obviously their marketing margins have improved drastically in this quarter to date.
Sumit, just a quick point. Do you think we'll see fuel price cuts by the government? Or, because one argument is if you cut prices at the pump, states will increase VAT. So what's the point? Or you think the centre may actually cut excise duty?
Yeah, so that is a very difficult question to answer, to be very frank, but that all depends because we are heading towards 2 state elections also. So how does the government play? I would like to myself watch for the same.
Okay. All right.
So Sumit, just if prices stay where they are right now, what would be the marketing margins for oil marketing companies in Q2 versus Q1? And what's the earnings growth then that we're looking at?
Yeah. So oil marketing companies, if you look at diesel margins, which have increased by almost 46% in Q2 till date as compared to Q1 of last quarter, FY25. So that is a significant improvement, and currently average is coming to 5 rupees 10 paisa per litre for diesel. And coming to gasoline, that is petrol, the margins have been very, very attractive. They have increased by 88%. They are currently average out to 7 rupees 30 paisa as compared to 3.9 rupees in the previous quarter.
Okay, all right. Thanks a lot, Peter, as well as Sumit, for joining in and giving us your inputs on this important oil price move that we are seeing. Wishing you guys a good day ahead. Well, for the time being, though, we'll slip into a short break. On the other side, we'll connect with Pavitra Shankar, the